I'm looking deep into my crystal ball. This is how I predict the future. I've predicted inflation. I predicted COVID responses. I've even predicted the future of real estate agents. And as I look deep into it, it looks a lot like my head, actually. Is this where I got the idea to shave my hair? Has my head become a crystal ball? Maybe the answers weren't in the crystal ball. They were in me the entire time. Where are interest rates going? Where have they been? And what can we expect in 24? All that and more on today's episode of Mortgage Monday. Christian Batchelder, welcome to Mortgage Mondays. How are you?
I'm doing good, David. The man, the myth, talking about rates today. Exciting conversation.
Not only are you doing good, but the economy is doing good. In fact, it's doing so good, according to the Fed, that they're not going to be cutting interest rates like many real estate investors were hoping for. And that's what we're talking about today. Are rates going to be going down? Are they not going to be going down? Are they going to be going up? What can we expect, Christian?
Yeah, I think back to January of this year when we posted a Mortgage Monday episode with the Fed's initial announcement, right? Kind of prospectively looking into 2024. And we were anticipating 5 to 6 rate cuts. At the time, that sounded pretty aggressive. That is what they said, though, right? So to kind of remind everybody, still so many people, even that I talked to today, that watch Mortgage Mondays, that are on BiggerPockets, that pursue this education, still don't quite understand the correlation between the Fed's rate decisions and mortgage rates. Mortgage rates roughly follow the federal funds rate. Roughly, there's a correlation there. However, if the Fed agrees to drop the rate, it doesn't always lead to a mortgage drop. Why is that? Mainly because banks are smart. If I can just summarize it into one sentence, that's it. These banks, these capital managers, they're very intelligent. They do very perspective analysis looking into the future. And when they heard the Fed say we're planning 5 to 6 rate cuts in 2024, they started to bake that into the price of their loans, i.e. their interest rates. So they were preemptively decreasing a lot of the margin on their loans, assuming that these cuts were going to come. So we had a little drop in rates. If you guys remember, compare November of last year to like February of this year, there was a significant drop. It dropped like 1.5%. It went from like 8 and we bottomed out right around 6. Now we've rebounded to around 7. Why is that? It's because the Fed now said instead of 6, we're anticipating 3 to 4. Well, even though there's no decision on the rate yet, right? Just like David said, this last meeting, the Fed decided to hold firm on the rates. They didn't decrease rates, but we still increased in mortgage rates. To a lot of people, the general public, that doesn't make sense. But when you think about the banks trying to forecast what is going to happen, anytime the news changes, that's what impacts mortgage rates. It's not necessarily the action that the Fed takes on that day.
Okay, and what is it about the news changing that impacts the rates more than the Fed's actions?
It's future, forward thinking, right? So if the banks are anticipating, hey, we know where rates are going to go, so we can start to cut some margin because we know what we're going to be able to borrow. The federal funds rate is what banks can borrow money at. So if they're anticipating cheaper money coming in the future, they can start cutting margin on loans, right? And they can issue these loans at lower interest rates, lower costs, lower points to close, etc. Well, if they now are anticipating rates are not going to drop by as much as they were anticipating, they're shaving back some of that drop that they took. If you guys are bored enough to go actually listen to the federal announcement when Jerome Powell, has his 2-hour press conference, right? I listen to it. I assume most of the general public doesn't. But when you're listening to it, you're not really caring about what he chooses to do today. When he actually decides, hey, I'm going to cut rates by a quarter, I'm going to increase rates by a quarter, I'm going to hold steady, that's not really the big decision of the day. The big decision is what he says about what's coming. And like I said, at the start of this year, he said 5 to 6 cuts. Now it's cut down to 3 to 4. Maybe we get like to 1 or 2. I don't know. I hope that doesn't happen, but that may be the direction that we're on. Those announcements are what move the market because that's what changes the perspective of what's going to happen. And that's what banks price on.
When other children were small, they were playing Pokemon and reading Harry Potter. Christian was following Alan's Greenspan and listening to the Fed. Let us know in the YouTube comments what your favorite Pokemon of your childhood was. All right, so Christian, what you're getting at here is that mortgage lenders don't just wait for the Fed to give an announcement and then adjust their pricing like we tend to think. They anticipate what the Fed announcement's going to be. They bake in where they think it's going to go with their prediction models into the rates. And then if his announcement is different than what they thought, they may adjust at that point. But if it's in line with what they thought, the rates already are what they are. And we're saying this because a lot of people wait for the Fed to come out and they're waiting to see what's going to be said before they decide if they're going to lock in a rate, if they're going to refinance, if they're going to buy a house. And it sounds like a good idea, but it's a bit foolish because the rates are usually already adjusted. Now, the reason the Fed is saying that they're not going to be lowering rates is because the reason they typically do that is to stimulate the economy. If they think things are moving too slow, it's like giving that little kid sugar. You want him to move around faster, lower down the rates. But we've already got a hyperactive economy, according to the Fed. I don't know if I agree with that. From what I'm seeing, it looks like things are a little tougher, but the metrics that the Fed uses have indicated that the economy is doing well. So they don't think it makes sense to lower rates or give the kid more sugar when they're already hyper. Is that a good summary?
Yeah, 100%. We've talked about a lot on this show. I know BiggerPockets has really talked a lot about this on their different shows. But really, the Fed is balancing inflation and employment, right? And unemployment's low. At least that's what unemployment report says. There's differing opinions on how accurate it is. And inflation has come down. There's really not any pain being experienced in the American economy yet. There absolutely is from household to household. But, on a national scale, there's not enough pain yet for Jerome Powell and the Fed to make that decision of an aggressive rate cut, because in their eyes, they're going well, right? They're combating inflation and unemployment is not spiking, right, in their minds, at least with their measurements.
Now, this Bankrate article that we're pulling this information from does say that many forecasters still expect mortgage rates to fall below 7% at some point this year. But for now, stubborn inflation numbers are keeping rates higher than what they had hoped. I think this is relevant to people who look at rates more than seasonal adjustments. And with my experience in investing in real estate, in the algorithm of my mind, I'm going to put more weight to the seasonal period that we're in as opposed to whatever the rates might be turning into. And what I mean by that is I tend to buy more real estate in October, November, December, January, maybe February than March, April, May, June, July, August, the summer months when more people are buying. So if you're someone who's been sitting on the fence, it might make more sense to get in and get that property where rates are now as opposed to waiting for summertime when more buyers enter the market and numbers tend to increase. What do you think about that, Christian?
I think seasonality is something that's not really considered in many real estate groups, right? Whether that's buyers, whether that's sellers. I mean, it's really easy. The first thing that comes up on Zillow and on news articles is inventory's up, purchasing's down. Well, are they considering that we're just going from like fall to winter? People don't move during Christmas, right? And people really like to drive home their analysis on like the month over month results. But it's like, why don't we look at the year over year results? Like that's probably a little more accurate. How does this winter compare to last winter? How does this summer compare to last summer? But that's not clickbaity, right? That doesn't get the views because people like to see the inventory drops by 10%, and it's not really true. You're just applying the seasonality of what just naturally happens in the real estate domain, right?
All right, so let's sum this up. It looks like rates are not going to be dropping as much as we had been told they would. Originally, we were told there would be up to 6 rate cuts in 2024. Now they're predicting 3, and it may go to even less than that. So rates have dropped, what do you say, maybe like 10 basis points or so, 11 or?
I mean, we're still below our peak. I would say the peak in the market was last year in November. We peaked around 8% for a primary. We are down 6.5 to 7 range now for a primary. So we have come down, a fairly substantial amount. But do I envision rates being at 4.5% like some people were saying in 2023? No, I don't. I think we're going to be in that 5 to 7 range for, probably the next year or two at least.
All right. So less rate cuts than what people were hoping for, but there's still a possibility that they could happen. And the seasonal changes will affect how many offers are going in on real estate. During the summer months, you get more primary residence buyers out there looking at homes. So that affects investors because you've definitely got more competition looking at these properties. And not all mortgage lenders are the same. They have different rates, they have different products, they have different offerings, they have different closing times, and they have different levels of service. So you definitely want to make sure that the person you're using is skilled in what they do. Now, BiggerPockets has a lender finder where you can be put in touch with different lenders, or you can reach out to someone that you know and just ask them about the products they have and where their rates are. Christian, if people want to reach out to you or they want to learn more about offerings that we've got, where can they go?
Yeah, obviously, guys, if there's a loan product out there that you've heard us discuss, we offer it at The One Brokerage. Website is theonebrokerage.com, all spelled out. Best way to get me is on Instagram. Shoot me a DM at The One Broker is my handle.
And you can find me at davidgreen24.com or at davidgreen24 on social media everywhere. Send me a DM with any questions that you've got. Now, if you like today's show, if you're bummed about rates not going down, or maybe you're excited that they're not going down because you don't want more competition in real estate, let us know in the comments on this YouTube channel what you're thinking, as well as what your prediction is for rates heading deeper into this year. As always, we hope you check out another BiggerPockets video if you've got a minute. And if you don't, we will see you next week on Mortgage Mondays.